All right, what's up, guys? Good morning and happy Monday. This is Taylor getting the party started for the 20th of March, 2023. Quick sound check on YouTube and a quick sound check in the free room. Hey, what's up, Mirza? Phil. Good morning, Miss Lorna. JB, Tony, and Will. All right, guys, the whole gang is here. So, as always, hope you had a good weekend. Hope you took a little bit of time to detach and recharge, because I think we got a pretty interesting week ahead. So, we'll jump in, guys. I did covered all the bases in the video that I put on the channel last night. So we'll cover a few of those things, but first, a quick look at the futures. Oh, it's been a pretty nutty morning, so I think I woke up around 4, grabbed something in the kitchen. Let me see. Yeah, at that point, we're down like 1%. Went back to bed for a little bit and woke up to a flat market. So the futures are already acting up here this morning, but the S&P futures are currently up about a quarter. The QQQ futures, the hero of the market, the last great hope, the NQ is up, 0.2%. Not going to knock your socks off. The small caps are up about 1%, and the Dow Jones futures, all 30 of the Dow stocks are up about a third. So a little bit of a pop here, if anything. Nothing that for now changes too much. So like I discussed in last night's video, guys, it's an interesting, as Dr. Carter would say, it's an interesting moment in time where right now I've got like 95% of the market telling me one thing. And then I've got maybe 4 or 5 stocks telling me the complete opposite. So the S&Ps, the Dow, and the IWM, for now, the structure, the momentum, all the pretty colors here, they continue to be pretty well aligned for a flush lower. So the S&Ps are still coiled up in that weekly squeeze. So at some point, remember, that weekly squeeze is going to resolve. Whether it be to the upside, whether it be to the downside, that remains a great mystery. But as far as the structure of your daily chart, right, none of this is really bullish. Under the 50, under the 21, under the 200, and we continue to print that daily sell signal. So none of that is screamingly bullish. Flip over here to the Dow, and the Dow's getting pretty rough. You hate to see that happen, but it's getting pretty rough. Weekly squeeze plus a weekly sell signal. So usually a combination for a pretty good flush lower. You take it down a notch to the daily chart. That's fully busted. You're under all 3 of your key moving averages printing a daily sell signal. And then a quick peek here at the IWM. And remember, a lot of the IWM stocks, the crappier, unprofitable companies, those tend to be the kinds of companies that bank with the Silicon Valley Bank. So something to keep in mind there. But it's all pretty ugly. Sell signals on the weekly chart. Sell signals on the daily chart, the 1 hour, the 30, the 3 minute, and the 1 minute. And you're pretty much just watching the small caps, try to fight for dear life here down at 170. They take out 170. I think your next target is 162 and change. So point being, 3 of your major indices, small caps, S&Ps, and the Dow, for now, the indicators would suggest they're an easier short. Until things change, or better worded, unless things change, going to continue to be easier for these 3 things to go down than it would be for them to go higher. So usually we take that information and we wake up and just get short. S&Ps are bearish, the Dow's bearish, IWM is bearish. We are looking to short the thing. And we might be looking to short the thing, but of course what makes it also interesting, on the other side of the pond here, the Qs are acting like we're in an uptrend. QQQ acting like we're back in 2020, the good old days. While the Dow, IWM, and the S&Ps have a weekly sell signal, QQQ here actually has a weekly buy signal. So that's all generally pretty bullish. Take it down a notch to the daily chart, and now we're sitting here in a daily squeeze with a daily buy signal. And then a few of the tech names. You've got Google, The big push there on Thursday and Friday. You got Microsoft. And according to my sources, Microsoft is up 15% in I think 2 or 3 days. So pretty nutty stuff. Apple had a pretty good week, right? All kinds of buy signals. AMD is a total animal here. That's got a bunch of buy signals. Nvidia continues to be a beast. So I think this week, guys, it comes down to, take your QQQ, take Microsoft, Google, take the 3 or 4 things that are trying to keep the entire ship afloat. And I think what you want to wait for here is that first back test to your hourly 21 EMA. So we'll anchor to Microsoft for sake of conversation. Right now, the question is all the strength here sustainable? Right? They're doing everything they can to plow money into Microsoft, plow money into Google. They're doing everything they can to keep the ship afloat. All right. Meanwhile, energy getting whacked. The financials, of course, they're getting pummeled. So you got a few heavily weighted names trying to save the entire market. So then the question becomes, well, is all that strength in a Microsoft, all that pumping they're doing in AMD, is that sustainable? If they can keep that going for another week, another 2-3 weeks, it doesn't exactly mean the S&Ps are going to turn the corner and rally back towards the previous highs. But sure enough, if Microsoft, Google, Nvidia, they continue to pump, just makes it a little bit harder to get that big flush in the S&Ps. So anchor to your hourly charts. And now the key here today, tomorrow, maybe Wednesday, how do these things handle that first pullback to the 21 EMA? And that's where I think we're going to learn a lot more about the market. And we're probably going to get some clues to work with. So the first outcome could be that the Qs, the Googles, the Microsofts, they all pulled back to that hourly 21, but it all behaves more like an uptrend, meaning we'll pull back a bit, we'll find support at the 21, we'll stabilize, and then from there we continue to party right back towards the upside. So if that is the outcome, understand the significance of that. These 3 or 4 names are carrying the whole market right now. If they handle that first hourly pullback like something that wants to actually trend higher, there's a good chance they could continue to keep the ship afloat. Instead, of course, Microsoft, the Qs, Google, they all come down to that hourly 21 and it fails to hold, meaning we break under the moving average. All the pretty buy signals turn into sell signals. Well, at that point, if they fail that first back test, I would have to think a greater likelihood, then you see a big flush in the market. All right, one of those things where just based on structure and momentum, the S&Ps are kind of begging to go lower. The IWM kind of looks like it's begging to break under 170. We want to be mindful of the only thing that's keeping them from doing that right now is the strength in a few of those names. So tie it all together, guys. Say you're looking to get long the market this week. You want a little AMD, maybe you want some Google, maybe you're fancying yourself a little bit of Microsoft. Well, even if you are bullish, there's a lot to be said for waiting for that dip. You get a better entry, you get a better risk versus reward, as opposed to chasing up here. So even if you are bullish on the market, I think you wait for that pullback, then you take it from there. Now, if you're in the camp that I'm in, and I'm kind of neutral on the market right now, but right now I got a short. So we got some 40-25 call credit spreads on the SPX here. And I'm looking to potentially add to that short. So what that pullback in a Microsoft or a Google could do for me, right, is one, maybe I do want to buy the dip. So maybe I got a better entry to work with. But 2, Google breaks down, Microsoft breaks down. If they begin to throw in the towel, to me, that would be a trigger to look to add to my short here in the S&Ps. And until that all happens, my friends, it's a little bit of hurry up and wait here. And then the rumor on the street is we're going to hear from everybody's favorite little old man, the one, the only Jerome Powell. So we'll see if he comes out and pumps up his chest and shakes up the tree a bit. But that is kind of it, guys. Recognize the market that we're in. We're not in the market where there's full alignment. Meaning if the S&Ps and the Dow and the IWM and the energy sector, the financial sector, if everything looked like the QQQ right now, Well, then it's all really straightforward, right? We know exactly what to do with that. S&Ps are printing buy signals, the Dow, the IWM, the QQQ. If the whole damn market is printing off that buy signal, our only job is to fight for a good entry to the upside. We're looking for squeezes, we're looking to buy the dip. It is a lot easier to swing trade during those moments of clarity. I wouldn't call the current market right now a moment of clarity. You got three of your major indices telling you one thing, and you got the one hot shot. Again, doing everything that it has to keep the Titanic above water. So wait for that first back test, see how they handle that back test, and then we'll take it from there. But for now, for those of you in the gold room and the mastery, we'll hang on tight to those 40-25 call credit spreads. And one last note here, guys, before I jump into the chat. Until we get more clarity from the QQQ, be mindful of how you're short the market. What I wouldn't suggest is getting short in a fashion where you need a big flush and you need it quickly. Like that's all going to be a little bit tough. The S&Ps might be perfectly aligned for a big dump, but if Microsoft goes up another 20% this week, it's going to be a little bit hard to get that flush. So I still think you can look to short the bounces here in the S&Ps, but do that in a fashion where you give yourself a little bit of breathing room. Now, admittedly, there's nothing sexy about a 40-25 deep out the money call credit spread, but what that does offer you is a way to get short the market with a little bit of that breathing room. I don't need the market to hit 3,700 this week. Would be pretty cool if it did, but I don't need that immediate flush. I can tolerate the market going lower in a slow fashion. I can tolerate the market trading sideways. I can even tolerate the market trading a little bit to the upside. Right? What I can't tolerate is a big push above 40-25. So I'm not going to double, triple, or quadruple my money on that call credit spread like we potentially could with some out-the-money puts, maybe some out-the-money put debit spreads. But while the market is trying to figure out the next move here, it is a nice way to have that short on the board without having to wake up to a limit down kind of thing. So be mindful of how you're short for now. And then one more chart for you guys. And she's a beauty. She is a beauty. Gold. The old gold bug here. So it's kind of funny. I've spent probably the last 2 or 3 years pretty much doing nothing but talking smack about gold. And now I want a little bit. So big old whopping monthly squeeze. A weekly chart that for now behaves like an uptrend. So going back to what I was saying earlier, wait for your first hourly back test in the QQQ and see how it behaves. Now, pretend you're looking at an hourly chart. That's what the pullback should behave like if you're looking at something that actually wants to trend higher. Like your first leg to the upside, first pullback to the 21, and from there you should stabilize and pretty quickly turn the corner and head right back up. So if the QQQ and Microsoft and Google, if they can do that, you might want to buy the dip, or if anything, just realize the market's probably not going to get torn apart just yet. If instead the QQQ handles that first back test like you did over here, a big push to the upside, indicator goes bullish, and then it kind of gives back all the goods on that back test, then look for a bigger flush in your market. So kind of a good visual there, what I'm talking about. But as far as gold goes, big old monthly squeeze, good looking weekly chart, and the daily chart here is just, it's off to the races without me. So any flush in gold offers a better entry. I think we might try to pick up a little bit of that bad boy. Now the futures here, the futures. Not much of a buyable pullback just yet. But that is that, guys. So if y'all got any questions, any charts you want to take a look at, feel free to throw them at me. And quick announcement here. For those of you with the big 3 indicator, we are going to push the update today. At least that's what they told me. So the pressure is on. But a few quick notes here. So for the upgrade, you guys will get access to pretty much everything associated with the big 3 signals. So I know at the very beginning of the indicator, it was just the colored bars and the labels. We've kind of turned it into a whole bundle of goodies. So for those of you with the indicator, they should shoot you an email when the update is live. What you will get with the update are the updated signals. And so we changed a little bit of the criteria that goes into a buy or a sell signal, speeding things up a little bit. So you'll get the colored bars / colored arrow. You'll get your multi-time frame labels. You'll get the updated heat map, right? The color-coded background that goes along with a buy or a sell signal. And then the big 3 histogram, which is basically just a MACD histogram with a couple of our buy and sell signals thrown into the mix. So what I'm going to try to do some point this week is film a whole video going over the updates, how to use the indicator, the heat map, the histogram. And I'll put that on the YouTube channel. That way, for those of you with the indicator, and even those of you who don't have the indicator, you'll be able to check that out and get a gist of all the updates. So a quick note on all that, guys, but I will jump in the chat here and see what you got. It might, and I hate to say it, but it might be a walk your dog kind of market for a few days here until Jerome comes out and does the thing. Yeah, JB, the scans as well. Yep, scans as well. Jim, good question. We got April monthly expiration, so we're all the way out. I say it like it's a long way away. Wow, we're going to be in April pretty soon. But yeah, we went with April monthly expiration. But I think wise on your behalf to put that trade outside of the Fed. So I think your expiration date is just fine. I think that should work, my friend. And man, I've been there before where I'll have a long, I'll have a short, maybe I got some spreads, whatever the case may be. And that trade doesn't really have enough time to get through Powell. Like it might expire that day, it might expire the next day. From my experience, it's never been a good idea. So I've kind of learned the hard way. All right, if we got JP and the boys coming out this week, all right, well, if they're talking on Wednesday, I'm probably going to put that spread somewhere next week. Like go a full week out the money to avoid any of the mayhem. Because y'all know how Jerome does it. That man comes out, he starts spitting on the mic. We are popping, we're dropping. And then a lot of times you get the legitimate reaction the following day. So you got some put credit spreads going into Powell. He does this thing, the market rallies. You're like, oh, Jerome, I love you, man. And then the following day, the real reaction, the market gets hammered. So yeah, I think good to avoid all of that. Woody, good question. So would I buy the QQQ, the hourly 21? Potentially. Now there's a template for that move, and what I mean by that is, here's a good example. I think it's great to come into the session with a few key levels in mind. Like, hey, here's one spot I might want to short it. Here's a few spots maybe I want to get long. I do suggest go into a session with a few levels identified. But what I don't suggest is blindly putting on that trade just because we've reached that level. So I think a good example of that would be the S&Ps from last week. So on Tuesday, because we came into last week knowing, all right, a bounce into the daily 200, a bounce into the 21, even a bounce all the way into the 50, we're willing to short those bounces. So Tuesday we popped right into that 200 SMA, and we put on the short. Thursday we popped into the 200. We did not put on the short. And the reason being was Tuesday, at your key level, you had the trigger for that short. Right? You had confirmation from your lower time frames that getting short actually made sense. You didn't have that confirmation on Thursday. So what I mean by that is, to me, here's the value of the heat map. We should already have a pretty good sense of what it should look like if that dip to the hourly 21 is going to hold and then turn the corner and pump right back towards the upside. So my expectation is, as we pull back to the 21, we'll lose a couple of these lower time frame buy signals. It would even make sense if the 1 minute, the 3 minute, the 5 minute, they might even go bearish. Right? Usually pretty normal. You get a good dip, your lower time frames go bearish. The key is what happens at that 21 EMA. More specifically, what happens here from the ground up, right? The 1 minute, the 3 minute, the 5 minute, the 15 minute, the 30 minute, all the time frames inside of your hourly chart should behave a particular way if we're gearing up for that big push. So to keep it simple, what I would look for on top of that hourly 21 would be fresh buy signals from the ground up. 1 minute, 3 minute, 5 minute, 15 minute, they're all going to get tossed around a little bit on that pullback. So my first confirmation that, all right, we might want to buy that dip is if those lower time frames can quickly clean up structure, quickly clean up momentum, and actually print a brand new buy signal. Right, go back and study that move. What you'll find is what triggers that big push off of your hourly 21 is your 1 minute, the 5 minute, the 15 minute, the 3 minute. They're all packing the goods. So it's a probabilities game. We pull back to the hourly 21, and my 15, my 5 minute, my 3 minute, if all these lower time frames are bearish and they're printing that sell signal, well, that's not the template for a big push off the hourly 21. So with these indicators, what I'm trying to do in my own trading is just getting more and more familiar with what things should look like. I love buying a dip to a 21 EMA. I love shorting a rally into a 21 EMA, but I don't want to do that blindly. All right, guys, we've pulled back to a level that we have deemed to be meaningful. So let's jump in and buy calls. That sounds too much like a coin flip. Know where you might want to buy it, but then have a sense of what it should all look like from the ground up. Right? Don't take your hourly chart at face value. Even if the hourly chart still has a buy signal, I need my confirmation. I need all my little soldiers lining up here from the ground up. So if on top of the hourly 21, the 1 minute, the 3 minute, the 5 minute, the 15 minute, they all go bullish, right? They all report for duty, so to say. Then you got a pretty good shot. But if they're all bearish and they can't clean up structure, they can't flip momentum, well, you're probably not teeing up here for a big pop. So maybe with any luck, guys, in the gold room this morning, we'll be able to take a look at things, through that point of view. So Woody, that was a long-winded answer, but the answer would be it all depends. I might buy the dip there, but only if the green beans are showing up from the ground up. Phil, 40.25, 40.50. So we're $25 wide. We got it for, I'll call it $10 a credit. I think I got like $9.90. So there's a nature of an out the money call credit spread. Our max profit per contract, we'll round up a few cents. We'll call it $1,000. Max profit is $1,000, and the max risk would be 25 minus 10, 1,500. So risking $1,500 to make potentially $1,000. Now we are putting aside some massive gap up. We are not going to hang out here until we're looking at max loss. So keep that in mind, guys, about spreads. And admittedly, I see a little bit too much of this in the gold room. Right, spreads are being open. You're risking $800 per contract to make $200 per contract. Well, you can't take that max loss. Like, it's freaking mathematically impossible to make money in the long run. If you're losing trades, wipe out $800, and you're winning trades, not even $200, right? How often do we actually hang on for max profit? So be mindful of that with spreads. There's the cost of entry. Like, hey, worst case scenario, here's my risk. Best case scenario, here's my max profit. But then what you want to do is aim to manage that trade in a fashion where you're working a good risk versus reward. I take my trade off above the 21 EMA. No, I'm not going to lose that full $1,500. I might lose $500. And now I've turned it into a trade where I'm risking $500 to make $1,000. So there's the cost of entry to get into the nightclub. Then there's a risk reward that you work based on your risk management. Little side note there. Yeah, Tom, I'll put that in the chat for you. I'll type that out for you, my friend. 4025. Credit spread at $10 of credit. I'm looking forward to the day where Tastyworks implements a copy and paste feature. If we got any Tastyworks executives in the building, it would be greatly appreciated. All right, guys, make sure I'm all caught up here in the chat. Yeah, Jim, I think you got to trade pretty similar to Sam's. I know Sam's got a few butterflies down at 3,500. Did he go April? Yeah, I'm pretty sure he went to April as well. So you're in good company. And Jim, put it this way. I'll be rooting you along. if your trade works, I should be in pretty good shape on mine. So we're in it together, my friend. That is Sam's trade. Okay. I don't have the butterfly with him, but I do got a little bit of skin in the game. If Sam's butterfly pins at 3,500, he owes me a Chili's gift card. Reason being is I shorted the market like an old man. 40-25 call credit spreads. It almost guarantees the market's going to collapse. So took one for the team there. But all right, guys, I got to be in the gold room in about 5 minutes here. So for those of you in that room, we will keep the party going in a few minutes. For the rest of you here in the free room, and remember, for those of you on YouTube, head to the Simpler website, check out the free room, and come hang out with me a few times per week. I'm in there, Cody's in there, Sam is in there. I'd say generally most of the team has a session in the free room every now and then. So I will be back here in the free room today at 1 p.m. Central, 2 p.m. Eastern. So I hope to see y'all back again at 2 o'clock. We will reevaluate, see how the cookie crumbled on a Monday morning, and we'll take it from there. But as a quick recap here, guys, indicators tell me S&Ps will go lower, easier than they'll go higher. They're telling me the same thing on the IWM. They are telling me the same thing on the Dowski. 2 tips. Qs are telling us the complete opposite. So just be mindful of the market that we're in. 3, 4, maybe 5 stocks trying to keep an entire stock market afloat. Now, maybe they can, but that all comes down to these names behaving like an uptrend. Right? There's a huge difference between a big spastic pop, a big spastic short squeeze that lasts 24 to 48 hours. Right? That can make for some good fireworks, but doesn't really give you anything to work with heading down the road. So that's a focus today. Looking for signs of continuation after a pullback in the Qs, the Microsofts, the Googles, all those animals. But all right, guys, thank you for your time as always. Hope you found it helpful, and I will see y'all later. Go get them.